Nolan, it's good to see you today. We are diving into the headlines, of course, Silicon Valley Bank and the markets. A lot of moving parts, which I know it was really important to you to communicate with your clients what's going on. So let's just start by saying, of course, the Fed is still working to stem a U.S. banking crisis. Things are changing day by day. But let's start with what's most important to your clients. What do they need to know?
First and foremost, I think what everybody needs to know is that their money is not held at a bank. So regardless of what's happening with some of these larger banks or smaller regional banks, a banking crisis is a little bit different than having money in investment accounts or insurance products. So first and foremost, in a segregated account or something held separately from a bank, there are just simply not those risks associated. There are still insurances in place, protections for investors, but large in part, unless you have direct bank investments, you should be relatively unscathed from at least the banking crisis part of what's going on right now.
Right. It is apples and oranges. But let's address then, I think, the next logical question. A lot of people are saying, okay, but I still do bank with my local bank, Nolan. What if I have more than $250,000 in the bank? Because that's the max amount the FDIC will insure.
Yeah, and that question's come up a couple times just
Yeah.
over the past week or so. That $250,000 limit is the FDIC insurance limit for bank deposits. So at one institution, that $250,000 is the most that the FDIC typically covers if the bank goes under. If you have over that amount, or you're pushing that amount, or just want to know what to do as far as options, a really simple one is to find another, what's called a global systemically important institution, a large bank, and consider just diversifying among 2 or 3 different banks. If you're at that limit or above that limit, it's a very simple way just to make sure that FDIC insurance is covering all of your deposits. And at least in the near term, it certainly seems like the government plans on stepping in and covering at least a little bit above that amount too, at least at certain institutions.
Yes, always sound advice. I'm sure you're getting this question a lot too. A lot of people want to know how this compares to the 2008 banking and financial crisis.
Yeah, and 2008, I think, rings a couple bells just because this is a banking crisis. This is a banking issue, and it's the biggest one that we've had probably in the past 15 years.
Right.
So in 2008, what we had was credit defaults. We had a whole lot of different situations with subprime mortgages. It's a little bit different than what we have right now. What we have right now is an issue with a regional bank that has different leveraging requirements. It's not properly planning for the deposits that they have, not properly planning for people withdrawing from the accounts and having to sell assets at a loss. So I think this is markedly different than 2008 because the government's already had a pretty heavy hand in making sure that consumers and businesses are protected regardless of a bank's failure to either disclose proper information or handle their finances appropriately.
Okay. So I feel like a lot of people want to know, though, Nolan, since you are steeped in this industry, you have many decades of experience. What are you watching for next?
So what we are watching for and what we kind of continue to watch for is just increased volatility in your portfolios. And we hope that with good GDP growth and inflation that the U.S. continues to grow and be profitable. But when we have that volatility and when we have those wild swings month to month, it's just important to know that we kind of factor that into your portfolio when we build it in the first place. There are protections in most cases that are built into portfolios to either alleviate some of those volatile strains or protect you in case of Fed action on bonds or whatever that might be. We kind of build portfolios expecting that. So I would just assume volatility, assume that maybe the banking industry and financials in general are going to have a little bit of a shakeup while all of this gets ironed out. But you can plan for those things in advance.
Right, which is exactly what you did. You didn't know what it was going to be, but it was part of the plan. That makes me feel so good to talk that through with you, Nolan.